Let's bring on board then Jyoti Jaipurya, Head of Research at Bank of America Merrill Lynch. She joins us on the show right now. Jyoti, hi, morning. How would you call the market right now? Do you think the best of the rally is behind us, or do you think it is, something different that we are going to see this time, and this could perhaps be just the start of it all?
What we've had is a very sharp move in the last 1 month.
Right.
So, there were obviously the positive factors with oil coming down, gold coming down. And so, everybody's now playing this theme that rates in India will come down. Current data will continue to be poor, but, let's think of the future, which will get better. My view is that there will be a cap on the market because ultimately earnings and the GDP growth are not going to be very exciting over the next 6-9 months. Secondly, we have elections towards the end of the year in major states and early part of next year for the, whole Lok Sabha. So to that extent, there will be those two factors which will put a cap on the market. What it's done is it's brought investors back. At least the interest is much more in India than we've seen over past few years. So like I was out for 3 weeks now, and generally most people seem to be quite positive on India. We had a lot of meetings and lots of asset allocators coming into the meetings.
Jyoti, so do you think it's a brute force of money which could surprise us on the upside? Because in the near term, more than often we've seen that liquidity and momentum, it tends to trump the valuation argument.
Yeah, sure. See, there are two things. One is, if you see historically, whenever interest rates are cut and there's a rate cutting cycle, whether it's in India, whether it's internationally, markets tend to go to valuations which are higher than what are long-term averages because the expectation always is that the future is going to be much better. So what you're playing is the cycle has bottomed out and you're expecting things to get much better in the future. So to that extent, even now, markets are like trading probably slightly above long-term averages and markets are starting to discount that things will get better. In a normal cycle, without an election and all, once rates keep getting cut, you expect that things will start improving 6-9 months down the road. This time, of course, we have the problem of elections, which may actually slow down the recovery a bit because near the elections, people may get wary. You can't expect really investment cycle to pick off till you've had a new government in place. So that's why this time the delay may be more simply because of this whole election which comes in.
So Jyoti, just coming back to the point that you were making, do you see more headroom left for interest rate sensitives, and do you think the RBI is actually going to oblige this time around with a rate cut?
Yes, my view is that what you have is one is inflation which is surprised on the downside. So it's, surprise estimates of most economists, RBI, everyone. So the numbers of course come below 5, which is what they have kept saying that they want WPI below 5. Second is global commodity prices have come down, and if we, I tend to do this bit of work. So WPI is very highly correlated to the CRB, which is the commodity index globally. So to that extent, inflationary expectations are coming down. Now, whether RBI cuts in the next meeting again or, they pause, we are expecting them to cut, but, even if they pause and say that they'll cut in the meeting after that, it probably, is okay as long as, we are expecting further cuts to come. The other thing from the RBI point of view is that we'll have a change in governor in September. Now, generally, the expectation of the market always tends to be that a new governor will, cut rates much more aggressively than the previous governor. My view is that, there really is no significant change in RBI policy when the governor changes. But at least that's the view the market will probably take over the next few months that, as we have a change in governor, the new governor will probably cut rates more aggressively. He'll of course come in with a better shape because, the inflation numbers are trending down. The second worry of RBI has been, the current account deficit, which is still high. So it's not like the current account deficit is low. But again, that number is improving for the better if oil prices come down, gold prices come down. So from RBI's point of view also, growth is slow. Inflation is starting to come down and, you're seeing a downtick probably in the current account deficit. So it does provide them a bit more flexibility than everyone thought they had a few months ago.
Jyoti, courtesy global liquidity, what to your mind are the chances that we could see a P expansion in Indian equities? Because we have seen a P expansion in a couple of key sectors in last 2 years. Pharma, FMCG, to a large extent consumer names as well. So if India continues to receive more money or more global dollars, earnings may not come back, but PE could expand. If PE expands, prices automatically will go up.
Yeah, my view is like a lot of the move we've seen in the market over the last 15 months is basically a PE expansion. There's no real earnings which are coming in. If you think of FY13 earnings have probably grown by, 2-3% or something like that. FY14, again, my view is that growth are going to be in single digits. I am looking at 7-8% earnings growth in FY14. So to that extent, what we have to, most of the returns which are coming are PE expansion, not really earnings growth. This is, very typical of a interest rate cycle. So it's not like this is extraordinary and it doesn't happen. Anytime interest rates are cut and markets tend to start moving up, the first leg of the run is because of PE expansion. What market hopes after the PE expansion is that earnings catch up at some point and the PEs then start to come back to normal. So I think you will see PEs go above long-term averages, which is very, very typical of any interest rate cut cycle.
Jyoti, I'm completely with you when you make a case that earnings are unlikely to improve. But none of those fundamental arguments of late have really made money. How should medium-term investors approach this market? Should they now, sit on the sidelines, focus on earnings, or they also should now jump in because the force of the money will ensure that this market will not correct in a meaningful manner? I mean, Jyoti, if you look at the screen, it is evident that, markets are doing something special.
Yeah, see, markets always tend to, give you surprises both on the upside and the downside. So, if we were having this conversation 6 weeks ago, then there would be enough reasons why market can't go up, because at that time everybody was focused on earnings. So, at any time, my view is whether the market is going up, it's going down, you have to focus on fundamentals and you have to focus on the future. The mistake which everybody makes is this earnings is not good, but is this earnings the bottom of the cycle? And second is, what are you paying for those earnings? So, those are two critical things to always focus on. If you're looking at the medium term, and most people, say they want to buy for medium term, but they tend to forget very quickly when the next quarter is not good. The medium term, you're probably going to make money in some of the rate sensitives, like you have to start thinking, okay, so if the investment cycle turns around in India, which probably it will, the issue is it going to be 2 years later, 3 years later, 4 years later? When that sort of thing happens, then what happens to the current earnings of some of these stocks? In fact, a easy template is go back to what these earnings were in 2006, 7, 8, when the investment cycle was very strong, and think of, can that same earnings come back 4 years later, 5 years later? So do these stocks look cheap on that sort of earnings, let's say if they come back 5 years later? That's, one easy template to play with. The other is just think of what is not done well and what is underowned now, because, over the last 3 years, most people played one theme, which was, I want to buy growth which is assured. I want to buy free cash flow. I don't want to buy the high debt companies. But if you think of the future, if interest rates come down, let's say they come down by 100 or 200 basis points, who are the companies who will benefit from that? The higher the debt you have, the more benefit you get. Like if you do a very simple analysis of put in, 2% lower interest rate in all the companies, you'll find that there are lots of companies whose earnings will probably go up by 30 to 50% just because interest rates are going to come down and they're running a very high debt portfolio.
So, Jyoti, when you say rate sensitives, is it restricted to just the banking and financial names, or would that list include trading moves on autos as well as real estate too?
Yeah, see, the rate sensitives includes everything. So what we've been playing for the last 1 year has been autos and financials, because my view was that these two sectors are the first ones to do well, because I think investment cycle will take much longer to pick up. So the first thing which will pick up when rates are cut are probably the consumption names. Investment cycle will get hindered by, one is the global environment is not great. Second is you have elections over the next, like now it is whatever 9-10 months or 1 year later you have elections. So to that extent, corporates tend to be a little wary of investing before. Plus there were a lot of regulatory issues which were delaying, the implementation of new projects. So to that extent, I said that will take some time to pick up, because on multiple fronts we have to take care of some of the problems. The consumption names will be the first to pick up. So that's why, like, we were playing the autos as our rate sensitive, and we were playing the banks because lending normally will pick up, as that will be the first sign that things are starting to improve. So as we move into this interest rate cycle, and just mind you, this again is going to be not like a 1 month thing or a 3 month thing, but it's probably going to pan out over 3 years, because if you look back, the defensives are done very well. Over the last 3 years, the defensive story did very well. So this again is going to be a 2-3 year story, and at that time, the industrial names will start to do well, which are the rate sensitives. You'll probably have the real estate participating also. So you'll have all these stocks participating, most stocks whose demand is sensitive to interest rates. And second is companies which are running very high debt on their books. They will probably gain some benefit when they start to come down.
Jyoti, last time when we interacted, you indicated to me that selectively you were hot on media. Are you still hot on that space?
See, it's a space which we don't cover very extensively. So yeah, there are some names which we like in the media which we cover, because there are some regulatory changes which everybody knows about, and that will help things improve in the media space. So there are some names we like, but like I said, it's not like a very wide coverage for us.
Jyoti, what are the kind of sound bites you are picking up from some of your clients? Are they still inclined to invest into quality stocks? Are they happy to pay that elevated premium for quality stocks? Or now they are seriously considering of shifting out of quality stocks, and they are looking at going down the ladder?
Okay, so last few weeks while I was marketing, we were having this discussion with a lot of people. So I would say a year ago, people were firmly into more of these defensive type of names where there were cash flows. And, as we have been pushing these rate sensitive, people have generally got, I think well owned in now probably the banks and some of the auto names. Even now, people are not willing to go further down, I would say, the quality on terms of rate sensitives. Not many people are willing to buy the really high debt companies which depend on the investment cycle to turn around, because for people this is going to take time, so I have time on my hand. My view is that that's still like a very uncrowded space at the moment.
Jyoti, what's the view on technology? While the numbers have been poor, the recent rally has somewhat got interest back into this space.
Yeah, that's probably, like, if you look at it in the end, tech has not really outperformed the market. It's probably underperformed the market. For me, I think more than the number, what I'm really worried about is the new immigration bill and how that pans out. Because, if you take the worst case of that immigration bill, then the hit on the tech companies could be quite a bit, and that could really shake up the market. It's like something political. We have to see what sort of amendments happen. I would say even now the market is expecting that bill to be toned down quite a bit and not hurt the Indian companies. But if that is not done, then that could be something which could be quite negative.
Right, Jyoti, appreciate the time and thank you for your insights.